Hello, everybody, and welcome into Commodity Culture, where we break down commodities markets, sound money principles, and geopolitics, all with the goal of making you a better investor in the commodities sector. My name is Jesse Day. Today is January 29th, 2026, and I'm thrilled to welcome James Rickards to the program. An investment advisor, lawyer, economist, and a New York Times best-selling author of books such as Currency Wars, The Death of Money, and his latest, Money GPT. James provides an incredible breakdown of the gold market and what's driving it, along with reiterating his call for a $20,000+ gold price and why it could happen much faster than anyone expects. James also dives into silver's run to triple digits and why he thinks there's plenty of upside ahead for the metal. We also discuss why Fed independence has always been an illusion, the Monroe Doctrine, and the method behind Trump's actions on the geopolitical stage, why it's good for the gold price, and so much more. So strap yourselves in for my conversation with James Rickards. James Rickards, it is great to have you back on Commodity Culture. I want to kick the show off with discussing precious metals markets, starting with gold, having quite the move recently, currently sitting at around $5,100, dropping from a new all-time high of over $5,400. That $23,000 gold target you've discussed seems to be getting closer and closer. How do you see the gold market unfolding from here? And what do you see as the main catalyst behind the sector that investors should be watching?
Well, I think gold, and it's funny these days when you talk to people about gold, they want to hear about silver also, and I'm sure we could talk about that. But gold and silver are going to go a lot higher. I feel very comfortable with that. There are multiple drivers, and I'll kind of go through them one by one. The drop. Yeah, when you get 5,500 in about a heartbeat, it was. I was watching the ticker. We're going to get to 5,000. Of course, I knew we would, but when it's 5,000, then I think I went to sleep and woke up. It was 5,500, so I was like a 10% drop. Literally in 2 days. So a little pullback's normal. Hedge funds. I always say hedge fund traders don't care about gold, silver, or coffee beans. They just trade. And so if you're a trader and you do a leverage bet on gold and it goes up 10% in 3 days, you probably want to get out of the trade and, mark it up towards your 2026 bonus. So that kind of volatility is normal, but it doesn't really tell us where to peak or anything of the kind. With that said, so what are the drivers? There are several. One is central bank demand. It's we've talked about that before, but it's a big deal. They from 1970 to 2010, central banks were net sellers of gold. Different central banks at different times, believe it or not, in the 1970s, even after Nixon suspended the convertibility of dollars for gold, the U.S. continued to sell gold. We sold about 1,000 tons over the course of the 1970s, got us from 9,000 tons in 1971 to about a little over 8,000 tons in 1980. Then we got the UK to do our dirty work. There are really technical reasons why the U.S. has not sold any gold since 1980. Probably don't have time to go into them. They're legal and has to do with when the Fed took the gold from the banks, but in the 1930s, the Treasury took the gold from the Fed. So they keep stealing it between themselves. But there are reasons to believe that, the U.S. has not sold any gold since 1980. You sell a little bit to the Denver Mint for coinage and get some more, but they've maintained that official level the whole time. There are reasons to believe that the U.S. cannot sell. Not only is not a seller, but cannot sell legally. So put that to one side. The UK sold about a third, almost half of their gold in the late 1990s, 1998, 1999. They weren't very savvy traders. They sold at $250 an ounce, not $2,500, but $250 an ounce. Practically gave it away. That was Gordon Brown was the Chancellor of the Exchequer. You see him around London and the Red Fort at different restaurants. So that's known as Brown's bottom. He managed to pick the bottom, a 30-year bottom of the market. He picked it and sold the gold. But even in the 2000s, Switzerland sold 1,000 ounces, and in 1,000 metric tons. Not ounces, 1,000 metric tons. And then there was an uproar in Switzerland. There was a referendum. It failed, but the people in Switzerland were to the point where they wanted a referendum saying that the Swiss National Bank could not sell any more gold. the referendum failed slightly, but the message was sent, and they have stopped selling gold ever since. That brings us to the IMF. The IMF sold 400 tons in 2010. Looks like 200 or so went to India. They never disclosed where the rest went. I'm pretty sure it went to China. But that was it. That was it for large sales by the Western central banks. Since then, central banks have been net buyers. Now, it's not the same central banks. The big buyers have been Russia and China. Russia went from 600 tons in 2009 to about 2,700 tons today. That's, they quadrupled their gold holdings. By the way, just as a quick aside, that's a big reason why U.S. sanctions on Russia in connection with the Ukraine war have failed, because they can never starve Russia reserves. Because Vera Nabiullina, who's the head of the Central Bank of Russia, I always say she's the only central bank in the world who really knows her job. She put 25% of Russia's reserves in physical bullion. At the start of the war in Ukraine in 2022, Russia had about $600 billion in reserves, but 150 billion of that was in gold, physical bullion. The U.S. couldn't touch it. The U.S. and Europe conspired to steal about 200 billion of Russian reserves in the form of treasury notes. Russia they had treasury notes, they had gold, they had some other instruments, some euro denominated notes, but it was mostly treasury notes and gold. And the U.S. and others tried to steal them. They're in a custodian in Brussels called Euroclear, which is one of the biggest custodians in the world. They have $47 trillion of assets in custody. They don't own it, but they're the custodian, registrar for all that. So that was supposed to be like this death blow for Russia. We froze the reserves. Then we were going to steal them, use them as collateral for a loan to Ukraine. Russia's lawfully acquired assets are being used as a collateral for loan to pay Ukraine to fight Russia. That's how crazy this whole thing was. It gets worse, but anyway, Russia's going to win the war. They'll eventually get those assets back. But my point is, why was that not a kind of a death blow to Russia's financial position? Well, a number of reasons, but part of it was because they had so much gold. Ironically, because of the effort to steal the Russian assets, central banks around the world, not just Russia, but others, started buying more gold, and it drove the price of gold up. So Russia has, do a quick estimate, has almost tripled the value of their gold reserves in dollar terms because of the run up in the price of gold, because the U.S. tried to steal the dollar assets of Russia in Euroclear. So what we did on the one hand by freezing and trying to steal assets, we gave an enormous $100 billion gift to Russia in the form of higher gold prices. So I think I have to do the math, but my estimate is they've made as much on gold mark to market as they lost in these assets stuck in Brussels. So, and I teach this. I teach financial warfare at the U.S. Army War College. So I try to explain this to the students. They're pretty smart. It's a hand-picked class, about 13. They're all kind of future big brains, or future high-ranking big brains, I should say. But and I got a lot of pushback on it. But when you explain it to people, they're like, "Oh yeah, that was kind of a dumb move." What the U.S. did. China, same period, 2009 to today, China's gold reserves have gone from about 600 metric tons to closer to 3,000 metric tons. They very likely have a lot more. They're non-transparent. Well, the People's Bank of China is transparent to a point, but they have another sovereign wealth fund called the State Administration of Foreign Exchange, or SAFE, which holds foreign exchange, including gold, and is completely non-transparent. So we don't know exactly how much gold China has, but there's good reason to believe that this 3,000 tons they report could very well be closer to 6,000 tons or more. So there's China. But you have other buyers: Kazakhstan, Vietnam, Mexico, even the Philippines, India, Japan, which is an ally of the United States, increased their gold reserves. So that does a couple of things. And obviously, it tends to drive the price up, not to stratospheric levels, but to drive it up. But on the other side of that trade, or that equation, is gold output has been constant, around 4,000 metric tons per year worldwide. Now, it hasn't been crashing, and I'm not saying peak gold. You can still find gold, but it's getting more and more difficult. Lower levels, lower grades. I invest in some gold mines, so I'm not a geologist, but have some familiarity with the kind of the economics of the gold mining industry. But, economics 101, first week, supply and demand. When supply is constant and demand is going up, the price goes up to clear the market. So that's one of the drivers. And it's really attractive for gold investors. Like by itself, it doesn't mean gold goes to the moon. But what it does mean is you have a kind of informal floor under the price of gold. No guarantees, but if the price goes down a lot, central banks, that's when they come in and nibble because they're pretty savvy buyers. So you have what I call an asymmetric trade where you have all the upside, but limited, in my view, limited downside because the central banks are putting a floor under the gold. So that's a high level dynamic. At the same time, when the U.S. and Europe froze those Russian assets, other sovereign wealth funds and central banks around the world are looking at this. Whether it's Taiwan or Japan or Saudi Arabia, some of these have, if not $1 trillion, close to $1 trillion in reserves. They're saying, hey, what if the U.S. doesn't like something I do? What if they want to treat me the way they treated Russia? Maybe I ought to buy more gold, and they are. I'm not saying they're dumping treasuries. The debasement trade, the narrative from Wall Street is, the world's dumping treasury securities. They're dumping dollars. They're getting out of the dollars. The dollar's over, buy gold, etc. I agree with the buy gold part, but everything else I just said is false. And we have data to back that up. The Treasury has a monthly report. It's called the TIC report, TIC, but basically it's a very simple spreadsheet. And they show all the major countries around the world, and then they show how much gold they have, how many treasury securities they have. I misspoke. How many treasury securities they have. And that's been fairly steady. I'm not saying the world is loading up on treasuries, but they're definitely not dumping them. That part of the narrative is false. And people talk about the dollar being the global reserve currency. Well, currencies are not global reserves. Global reserves are securities. And people don't make the distinction between a currency and a security. Now, the security is denominated in the currency, of course, and that's really what people mean. But it's not like the central banks have pallets of $100 bills in the basement. They don't. They have treasury securities, 2-year notes, 5-year notes, 10-year notes, short-term bills, all the different maturities of treasury securities. And they are not dumping them. If they sell any, and sometimes they do, it's more a sign of dollar strength than dollar weakness. And the reason for that is, why would you sell your treasury securities? Well, it means you need cash, because treasury securities are not, as I just explained, they're not cash. If you want cash, you got to sell the treasuries, get the cash. What is China doing with the cash? They're propping up their banks and propping up their currency. That's not a sign of dollar weakness. It's the opposite. It's a sign of dollar scarcity and weakness in the yuan or the Japanese yen, as the case may be, and all these other currencies. So even to the extent that some of the countries sell a little bit of treasuries, it's more because they're desperate for dollars, not because they're dumping dollars. So the reality is actually the opposite of the narrative. It's still the Great Reset and the end of the dollar and all this stuff. It's just not true. It is true that the price of gold is going up, but for some of the reasons we just mentioned. Beyond that, there's a simple bit of math that accounts for part of what's going on. And here we can introduce, when I say simple, this is 5th grade math. We don't need calculus for this, but we can introduce behavioral psychology. And in behavioral psychology, we're all humans. We all have cognitive biases, many of which have been identified through pretty good experiments. And one of them is called anchoring. And anchoring means we get an idea in our head, and we kind of anchor on it, and we begin to filter all the evidence through that one idea, through that so-called anchor. And one of them, recently, but very much so now, but in recent years, is we think about the dollar price of gold and how much gold we have and how much money we made, at least on a mark-to-market basis. So let's just take a very simple example. Let's say you have 50 ounces of gold, and gold goes up $1,000 an ounce. Well, you just made $50,000, mark to market. Okay. And it goes up another $1,000 an ounce. You just made another $50,000, and so on. So people get the $1,000 an ounce times 50 equals $50,000 in profit. They get that in their heads. And it's real money. I'm not saying it's not true. It is true. But that's how they think about the market. But what a lot of people don't realize, at least not right away, is that each one of those $1,000 increments is easier than the one before because it's a smaller percentage gain off a higher base. So when you go from $2,000 to $3,000 an ounce, that's a 50% gain. That's a heavy lift. That took a while. When you go from $3,000 an ounce to $4,000 an ounce, that's a 33% gain. It's a lot less than 50. Well, that just follow that through. When you go from 4 to 5, that's a 25% gain. But when you go from $9,000 to $10,000 an ounce, that's only an 11% gain. So it's just, again, same $1,000, same $50,000 profit, but 11%, that's almost like a good week the way gold's been going lately. So my point is, people are looking at these $1,000 benchmarks, and that's fine. It's real money. But we made it to 5. We're going to get to 6, but you're going to go 8, 9, 10 really fast for the reason I mentioned, which is it's just easier. And then when you go from 19,000 to 20,000, that's only a 4% gain. 5%. No, sorry, 4% gain. So that's like a day's trading the way it's going lately. So these benchmarks get easier, and that's why people who watch gold go from 2,000 to 3,000 like, oh man, it'll never get to 20,000. My point is it will, but it could get there a lot faster than people expect.
The sponsor of today's episode is ARK Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arksgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. Great summary on the gold market. I want to turn to silver for a moment because silver has been going absolutely ballistic recently, hitting triple digits faster than I think almost anyone anticipated. We're now in a reality where silver is trading at around $109 an ounce, correcting much like gold from a new all-time high where it was close to 120. Have we entered a new era for the silver market where higher prices are here to stay, or would you be cautious of a further pullback up ahead?
No, I think silver is going to continue to go up for a number of reasons. Number one, the math example I gave for gold, it applies to silver also. Now, maybe you can use a $10 benchmark instead of a $1,000 benchmark. But again, going from 90 to 100 is 11% versus going from 40 to 50, which is 25%. So those $10 benchmarks, 110, 120, 130, they just get easier. And so I've got silver going to 200 without too much difficulty, number one. Number two, silver's going to tag along with gold. There's no way gold's going to the levels I expect where silver's not along for the ride. You're not going to have $20,000 gold. We'll get there. It's going to take a while to get to $10,000 gold. We'll get to $20,000 gold, but that's not going to happen without silver going to 200 or higher. So, it's kind of hitching your wagon to the right horse, so to speak. So silver will go along with gold. But there are other dynamics that I think are unique to silver, or at least they don't apply as much to gold. One of them is that silver is a major technological industrial input. Gold is not. Gold's actually not good for very much except money. It's probably the best form of money, but the industrial applications of gold, they're extremely limited, very, very specialized. I've visited a number of the biggest refiners in the world, and I talked to people about this. I once asked a guy, he was the head of Argo Heraeus, one of the biggest refiners in the world. Could he make 5 nines? 4 nines gold is 99.99% pure gold, and there's a process for it. And I saw it kind of play out. I said, just out of curiosity, could you make 5 nines? He said, we can, but it's not worth it because it's the added expense and energy inputs and things you have to do to get there don't give you more value in gold terms relative to 4 nines gold. It's just not worth it, except for certain. He said, ultra thin wiring. If you want that, we can do it, but it's really, really specialized. But basically, coating a space helmet maybe, but basically gold is not good for much. other than money. Silver is different. Silver is used in wiring, electronics, catalytic converters, weapon systems, all this AI, frenzy and building these massive data centers and the processors. That all requires a certain amount of silver. Yeah, other things too. Cobalt and copper, galore, silicon, and rare earths. They're all needed as well. But silver is an input to all that. So silver has a precious metals vector and an industrial input vector. They don't have to go in the same direction. You could have a bad recession and an AI blow up where industrial demand is going down and precious metals going up, or vice versa. But at the moment, they're both going up. The industrial demand is huge, and the precious metals demand is huge. And there are other things going on that are, non-transparent. You hear a lot of rumors. Some of them have some merits, some not. You hear about enormous physical demand for silver that cannot be met or satisfied by paper silver contracts. People who sold silver on paper, they're being called, say, "Hey, deliver the silver." It's like, "Oh, wait a second. I thought we had a trade here. You want silver? Well, that's different. I got to go find it." So there's enormous demand coming from all over. I've heard reports, I can't verify them, that China is hoarding silver. Why would they do that? Well, the answer is what we just discussed. They're trying to beat the U.S. in the AI race. So the open trading relationship between China and U.S. is pretty much off, at least in that sector. Maybe soybeans are moving, but not too much in the AI NVIDIA chip world. So China knows that if they're going to keep up with the U.S. in electric vehicles, where they're probably ahead, AI, they're not ahead, but they're trying to catch up. Military applications, same thing. They're going to need a lot of silver, and so they are hoarding it. They're just buying it like crazy and putting it away in inventory, basically, for future use. And then you do hear a lot. This is another one of those narratives that doesn't hold up to examination. You hear people say, "Well, the physical longs and silver futures, so COMEX or London Metals Exchange, are massively greater than the amount of silver in the warehouse, and they couldn't possibly meet that demand, and they're going to default." And my answer, at least with regard to COMEX, but the LME as well, read the rule book. I'm a geek, so I've actually read all the exchange rule books, all the major exchange rule books. And the first thing that jumps out of you when you read an exchange rule book, they have a rule that says they can change the rules. So it's like if markets, disorderly is a key word. If markets become disorderly, the board of governors can meet, they can issue orders and change the rules as they're understood on a day-to-day basis. So they have a defense mechanism. Number two, they say plainly, and it's on the websites, it's everywhere you look, we are not a source of supply. You should not look to futures exchanges as a source of supply. Now, you can take physical delivery. There is a process for that. There is silver in the warehouse for that reason, and it's really designed to keep the arbitrage between paper silver and physical silver in line, so it keeps everybody honest. But the idea that every long silver contract holder could put in notice and take delivery of silver, it's never going to happen. The idea that that would somehow bust the exchange is not true. What would happen is the board of governors of the exchange would issue a rule. They would say trading for liquidation only. That means if you're long, you can pair off with a short. If you're short, you can pair off with a long. Settle the contract. One side or the other writes the check, release the margin, settle it financially, but you don't have a right or even a strong expectation that you can take physical delivery. So all this stuff, there's not enough silver in the warehouse. There's exactly enough silver to meet the demand that they're willing to satisfy. But beyond that, they would just say no deliveries and just pair off your contracts. So you're not going to bust the exchange that way. And people who say that, they're just kind of scaremongering a little bit. But having said that, it is a data point and one more reason to think that there are scarcities in silver which go above and beyond, I'll call them normal scarcities in the precious metals market. So so silver's got some drivers that are different from gold, but they're all pushing in the same direction.
Let's talk about the recent FOMC meeting, which saw the Fed hold interest rates steady in the face of Trump's demand to lower them, and what Powell says is a politically motivated criminal investigation that is being placed on him. Why do you think Trump is so dead set on lowering interest rates here? And if he does get his way with the new Fed chair, as he's been alluding to, that will lower rates at his command, how could that affect markets and the gold price?
Well, show me a real estate guy who doesn't like low interest rates. I mean, this is like Trump's it's in Trump's DNA. He wants lower interest rates. Um, but he's operating under a major misconception. First of all, Trump's going to get lower interest rates, one way or the other. And I agree with you, Jesse. What Powell did yesterday or a couple of days ago was completely political. He just wanted to poke a stick in Trump's eye. The Fed should cut interest rates. They're behind the curve. If the Fed funds target rate is almost irrelevant, the Fed funds market isn't that big. It used to be critical, back in the day. It's not anymore. It hasn't been since 2008. If you want to know what short-term interest rates are, look at the 4-week Treasury bill, which is traded, very liquid market, or look at something called SOFR, SOFR, which is the secured overnight financing rate, which is basically the repo rate. Both of those recently have been lower than the Fed funds target rate. So the Fed funds target rate is kind of irrelevant. The market's already lower. The Fed's not leading the market lower. The Fed is following the market lower. And what they did the other day, where they kept rates they did not cut rates. They paused. They didn't raise them, but they didn't cut them. They just paused. It widens that gap and puts the Fed even further behind the curve. So why did Powell do it? Well, you mentioned the reasons. The Department of Justice started a criminal investigation of Jay Powell. I think Jeanine Pirro is the United States Attorney for the District of Columbia. He's got a grand jury. They've subpoenaed Powell. They've subpoenaed the Fed. It's serious. You can make fun of it. I don't mean you personally, but other people. But it's a criminal investigation. I'm sure they'll lawyer it up, and I'm sure they're concerned about it. So what happened when that was announced? Jay Powell gave an extraordinary statement, written, but also a video statement. I think they put on social media, maybe the Fed's website, saying this is threatening the Fed's independence. It's vindictive, etc. Well, independence is one of those words, one of those go-to words for central bankers all over the world. We have to protect central bank independence, and then all of a sudden, all the central banks in the world, all the big ones, ECB and others, came out and said, yes, we have to protect the Fed's independence. Trump's trying to interfere with the Fed, etc. And then all the living former Fed chairs, Greenspan, Yellen, and Bernanke, came out with a joint statement saying, don't mess with the Fed, don't disturb the Fed's independence, etc. So they played Powell and central bankers around the world played independence like a trump card, no pun intended, to basically put Donald Trump in a corner. And they didn't cut rates the other day because they went to poke a stick in his eye just to make a point. Now, here's the thing. Fed independence is a joke. It doesn't exist. They pretend it does. And like I say, it's a trump card. But in 1913, when the Federal Reserve Act was signed by President Wilson and the Fed was created, the Secretary of the Treasury was a member of the Board of Governors. The Secretary of the Treasury was on the Fed by statute. It wasn't like the president said, hey, Treasury Secretary, we want you on the board. By statute, it said the Treasury Secretary had to be on the Fed board. In other words, there was no separation between the executive branch and the Fed. The Federal Reserve was a central bank. It was owned by the banks, but it was serving a purpose. And the Treasury Secretary was on the board. They met. Fed meetings in the early days were in the Treasury building. That was just, tell me there's any separation. But there wasn't intended to be. The idea was the Treasury and the Fed would work together. Then come forward to period 1942 to 1951. Federal Reserve policy was explicitly subordinated to fiscal policy. President Roosevelt wanted low rates to fight World War II, and he got low rates. So basically the White House told the Fed, you keep, I think they kept the 30-year bond around, 3% or maybe a little bit lower, and the intermediate maturities were around 2.5%, but they kept interest rates low on White House orders to fight World War II. Then come forward to 1965, Lyndon Johnson physically assaulted the chairman of the Federal Reserve, William McChesney Martin. He invited him down. He grabbed him and shoved him up against a wall and said, because Martin had just raised interest rates, and Johnson didn't want that. Johnson wanted low rates because of the Great Society and the Vietnam War. And inflation was just starting to take off. That extreme inflation that we had in the late 1970s That started in the 1960s, at a much lower rate, but 65, 66 was when, the people started saying, hey, what's up with inflation? But Johnson physically assaulted the man. So show me the independence. And then in 1972, Arthur Burns, who was chair of the Fed, lowered interest rates to help Nixon's reelection, which worked because Nixon got reelected. He had other problems later on, but Nixon got reelected in 1972, one of the greatest landslides in U.S. history, in his favor. But Burns had lowered interest rates to let that happen. I'm not saying there were not consequences. There were, but I just gave you 4 examples where, again, Fed independence is a joke. Now, recently, in the last 20 years or so, this independence thing has become a mantra. But think about it. If you had the only printing press in town, wouldn't you tell everyone else to get lost? I mean, of course, the Fed's going to say we're independent, because the truth is the Fed works with the White House when they feel like it, and they fight the White House when they don't like the president. Powell doesn't like Trump, so they're fighting. But the notion that somehow central banks are off limit is nonsense. It's a myth. It's another one of these narratives that they push out there, and it's just not true. You have to kind of know the history and see the reality behind it. Having said that, what Powell did was sort of vindictive, but meaningless, because, as I mentioned, market rates are going lower. Now, back to Trump. We said Trump wants lower interest rates. He does. But there's an old saying, proverb, be careful what you wish for, because Trump's going to get lower interest rates. I see the 10-year note going down, yield to maturity on the 10-year note going down from 4.25 to, 2.5 in the not too distant future. I think we could see 4-week Treasury bills going down to 1% or 1.25 again in the not too distant future. Interest rates are going to come down a lot, but they're not stimulus. That's another narrative. Now, cutting interest rates is stimulus. It's not. Low interest rates are associated with recession and depression. The longest sustained period of very low interest rates in U.S. history was during the Great Depression. There's no stimulus. You can't get stimulus from fiscal policy. You can't get stimulus, at least nominal stimulus, from inflation. There are ways to get the economy going, but cutting interest rates is not one of them. Interest rates are more of a lagging indicator. A healthy economy, like a really strong economy, the kind of economy Trump wants, interest rates should be 4 or 5%. That's what a healthy economy looks like. Why would I borrow at 4%? Well, that's because I think I can make 10% and I can leverage my investment 2.5 to 1, and I can get 25% returns on equity, and I'm hiring people and investing in business. That's what a healthy economy looks like. And 4 or 5% interest rates are completely not only compatible with that, but normal. 2% interest rates, 1% interest rate, they're not normal. That's what happens in a recession. So again, I would make the point that Trump's going to get lower interest rates. By the way, a good deal for investors in U.S. Treasury securities. You buy a 10-year note and it goes from the yield goes from 4.25 to 2.5, which I expect. You're going to have very large capital gains on that Treasury note, or you can just hold it and collect a 4.25% yield in a world of 2% interest rates. That's a sweet deal. In 1981, you could have bought a 30-year Treasury note yielding 14%. So you could have sat there from 1981 to what would it be, 2011, collecting 14% the whole time on a Treasury bond. So yields are coming down. Trump's going to get what he wants, but he's not going to be happy about it because it's going to be a sign of recession. And Powell's kind of irrelevant. He's out in May anyway. We'll see what happens with the criminal investigation. But this whole thing of independence is just another one of these false narratives.
I want to move to the geopolitical stage because a lot of events are moving forward at a rapid pace, particularly since we kicked things off here in 2026. We've seen the abduction of Venezuelan President Nicolas Maduro, the possibility of the U.S. acquiring Greenland. Trump has been fairly adamant on that. And now a potential attack on Iran brewing. What are your thoughts on how things are transpiring here? And what do you think the end game is for the Trump administration?
Well, I would say 2 things. In November, the White House released the National Security Strategy. It's about 25 pages. It's written in plain English. I think they did a very good job. I like the strategy. I also like the writing. It's good writing. They avoided all the jargon that usually comes with those. It was very clear, and it made it clear that the U.S. is returning to the Monroe Doctrine. Not that we ever totally left. And we have the Trump corollary to the Monroe Doctrine. The Monroe Doctrine was issued by President Monroe in 1823. And that was at a time of revolution in South America. You had Simon Bolivar and Bernardo O'Higgins and some of the other great San Martin, the great liberators of South America and all these revolutions. And Monroe was concerned that when you have revolution, you create a power vacuum. If you overthrow a colonial government, is your house salad is your new government. It seemed in Monroe's mind that there was an opportunity for Europe to intervene and recolonialize parts of it. And he said, "No, Europe, keep out. South America is our backyard. We're watching it. Yeah, there's a little instability or revolutionary fervor in the air, but Europe, keep out. This is not an opportunity for you to come in and colonize the Western Hemisphere again. Don't even think about it." So that's the Monroe Doctrine. Come forward to, I believe, 1904. Could be off by a year, but I'm pretty sure it's 1904. You had the Roosevelt corollary to the Monroe Doctrine. And he said, not only does Europe have to keep out, but the United States reserves the right to intervene. It's our backyard. We can go in our backyard and clean up a mess. We've done it 100 times. I mean, Nicaragua, Dominican Republic, CIA sponsored a coup in Brazil in 1964, et cetera. So, Salvador Allende. There are numerous examples of covert and military intervention, occupation in South America, and Central America, all consistent with the Roosevelt corollary to the Monroe Doctrine. Now we have the Trump corollary. And Trump embraces the Monroe Doctrine and the Roosevelt corollary, but adds a new condition which says not only can we intervene, but we are not going to permit powers outside of South America to control or interdict the supply chain. So Chinese oil, forget it. Oil going to Cuba that's supported by Russia, forget it. Expropriation of U.S. assets, don't even think about it. And this is what the Nicolas Maduro capture was all about, because now Trump's turning to Venezuela. He's restoring assets to ExxonMobil, ConocoPhillips. Chevron never left, but they're going to get expanded drilling opportunities. So they're going to get those assets back. I'm not sure ExxonMobil actually wants them. Their CEO told Trump, he said, "We've been expropriated twice. You're going to give us our assets back. Are they just going to steal them again? I mean, what's up with this?" So Trump's got to figure that out. But they will. But all that Venezuelan oil is going to be under the control of U.S. oil companies. There's a lot of gold in Venezuela. There are rare earths. It's a very rich country. It's corrupt and poorly managed and communist. So that's why the people are poor, but the country is rich. You just have to have better leadership, and Trump's going to see to that. But the U.S. is basically going to run. I don't think we're going to put the 101st Airborne in Caracas, but we're going to run Venezuela at a distance. But we're going to make sure that the rare earths and the gold and the oil and everything I just discussed are for the benefit of U.S. companies and U.S. supply chains. So that's but apply that to Peru, silver in Peru, copper in Chile, agriculture in Argentina, who knows what in Brazil. They kind of got everything, and so that's what that means. So it's a very big deal. Now, having said that, it doesn't mean the rest of the world's peace, love, and understanding. You got a war in Ukraine. You've got a possible attack on Iran. You've got threats against Taiwan from China. Even Japan is talking about developing nuclear weapons. I mean, they've got the technology and the uranium. It would not take much for Japan to create and test a nuclear weapon. They certainly have that capability. They could probably do it faster than anyone. And they may move in that direction because they're looking at the U.S. saying, well, wait a second, you're focused on Latin America. Okay, what about us? We're out here on the first island chain. Now, after the National Security Strategy, which came out in November, just a few weeks ago, we published the National Defense Strategy, which is a complement to the National Security Strategy. By the way, these things don't come out every year. They come out there's no set timetable, but every 4 years, kind of once in each new administration. And they guide policy for multiple years. So again, very big deal. I encourage people to read them. But but the national defense strategy makes it clear that we're going to defend what's called the FIC, or the first island chain. That's basically, well, it's not basically, it's Japan, Taiwan, and the Philippines, and some smaller islands. The islands closest to China. There's a second island chain, which is Guam, and some other islands, and then you get all the way to Hawaii. But we're going to defend that. And our attitude to China is we don't want a war. We don't want confrontation, but we want containment, which means, hey, China, do your thing, but don't even think about crossing the Taiwan Straits or picking up Taiwan or threatening Japan. Having said all that, Japan is, they've got a new prime minister, Takaichi. She's pretty hawkish. They've been building up the Japanese defense forces, and they've got to kind of look out for themselves at some point. Same thing in South Korea, although South Korea is a more difficult case. So it wouldn't surprise me to see Japan say, hey, we're going to get our own nukes. England, France have them. Why not? As we say in Philadelphia, why can't us? So they'll do something along those lines. But yeah, attack on Iran seems likely at this point. I don't have inside information or an exact date, but the White House, this White House, when they say stuff, they do it. It's not just talk. And when Trump gives a deadline, he sticks to it. Now, occasionally they move the deadline, but not very far, just long enough to give the other side time to respond, or work things out. But if you don't, then you end up like Maduro. So as far as Iran is concerned, the question is, will Iran come to the table and negotiate a verifiable deal that says they will not develop highly enriched uranium, they will not develop nuclear weapons or ballistic missiles, and again, do it in a verifiable way? I don't think so. I don't think that's the deal that's on the table. I don't think they'll take it, and so I would expect Trump to attack, and this will just make people buy more gold. So kind of come full circle.
Well, James, fantastic conversation, amazing insights. Before I do let you go, tell us about your latest book, Money GPT, and anywhere you'd like to direct people who want to follow your work online.
Sure, thank you. I'm on Twitter, X now. Started back in the Twitter days on X. It's at Real Jim Rickards, all one word, Rickards. So at Real Jim Rickards. If I do interviews, including this one, I'll put the link on that. So it's a good way for people who are interested, to follow the interviews, etc. My most recent book came out about a year ago, but more timely, if anything. It's called Money GPT. It's about artificial intelligence. It is not a stock picker book. It doesn't tell you whether you should buy NVIDIA or not, or AMD. I'll leave that to Wall Street. It talks about the impact of artificial intelligence on markets and trading, and the extent to which we've automated trading is enormous. I mean, 95% of all the trades on the New York Stock Exchange are done by computers. But with AI, you can go further. You can create algorithms and tell the computer what to do in certain scenarios, authorize it to trade, and it'll just go on autopilot. But the weakness is, major problem is all those algorithms are the same. The idea that every trading shop or every investment bank has got unique algorithms, and they're going to act like specialists, buy when others are selling and vice versa, make market. It's not true. All these algorithms are the same, which means they're all going to act the same way at the same time. But without human intervention, no ability to call time out and say, hey, wait a second, maybe I should be a buyer here. And so the potential market crashes have been around at least since the 14th century, probably older. But the next one, driven by AI, is going to happen a lot faster and kind of be unstoppable. And I explain exactly how that dynamic works. I also talk about biases and what they call hallucinations, or just, what good is AI if you have to be a subject matter expert to see the errors? Might as well just do it yourself. And if you're not a subject matter expert, you're not going to see the errors, and you're going to believe them, and that'll create other problems. And I also talk about why superintelligence or artificial general intelligence, but that's the kind of computing power where we are to the computer as the gorilla is to humans. Like they're smarter than we are. Is not going to happen. But I have a very, I think, rigorous philosophical, historical, and mathematical explanation as to why that's not going to happen, which may take some of the wind out of the sails of people like Mark Zuckerberg or people running Google and elsewhere. So I hope people enjoy it. But it's Money GPT.
Great. I'll put links in the description below to your account on X, as well as a link where people can pick up Money GPT. Thank you so much, James. As always, it's been a blast.
Thanks.
Thank you for joining us today. Our sponsor, ARK Silver, Gold, Osmium, has some great prices on silver bullion products right now. They are on your screen. These are subject to change, and well supplies last, so be sure to reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arksgo.com, and make sure to tell him that Commodity Culture sent you, and pick up your Commodity Culture Stack Silver, not Fiat t-shirt. Represent sound money in style using the link in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.